Management. Hi, David.
How are you, Rudy?
I'm fine, thank you. Are you fine too?
I'm very well.
And ready for it?
Very much so.
Good. And we also have Gary Glover from Novus Capital. Hi, Gary. How is Montgomery funds looking at the whole volatility record? Because in essence, this can linger for quite a while again.
Yeah, so the issue is that the Greek economy is sub 250 billion, so half the size of New South Wales. Its indebtedness is well over 400 billion, so approximately 175 or 180% of GDP. So they're broke.
Yes.
The question is, does this ever extend to Italy? And the issue is that Italy's debt to GDP is about 132%, and Italy is 10 times the size of Greece, and that is scary.
Yes.
So the IMF, the ECB and the like will do everything in their power to ring fence this issue, and it is an issue.
Yes, because there's also there's a lot of banks, of course, which are still exposed to
correct.
Greece.
They are broke, right?
Yes, exactly.
So the banks have to, at some stage, take a massive haircut, probably 70 or 80 cents in the dollar. So that's a fact of life. But does it hurt Joe average industrial company? Probably not, but certainly could influence sentiment.
Yes.
And certainly, as Gary says, we'll see a certain amount of volatility over the short term.
Before we go to the caller, has Montgomery Funds been buying shares this week?
We bought in the latter part of June and reduced our cash by about 5 percentage points in the latter part of June.
Okay, and Gary, you'll be...
Yes, I do. I'm asking about Flexi Group. It's pulled back a fair bit, and it's based on an announcement. I think the CEO is pulling up stumps earlier than expected, or something like that.
Yes.
But I think their earnings forecast is in line with their expectations. So I was wondering if it's a good time to buy. Yeah.
Okay. Well, I actually think it's definitely a stock on my radar, and I was as surprised as many other people that the stock did dive as much as it did. In fact, before we went into this program, I spoke with the two guests and I said, I'm introducing a new phenomenon on the share market. Well, not introducing, it's already happening, but I'm labeling it. It's the minus 20% club. And Flexi Group has been one of the members in recent times, so I'm very interested also what the panel has to say about this. I'm going to start with David.
Yes, Rudy. Well, that was actually one stock we added to in late June. As the caller quite rightly said, the CEO left the organisation. We actually quite liked him. Unfortunately, the market didn't think he was charismatic enough. But there you go. We liked him. They reaffirmed their guidance of, I think it was $90 to $91 million. But you know, companies are funny. Charisma, as far as I'm concerned, plays a far too major role in selection of CEOs. To me, it's about producing the numbers year in, year out. And I thought the guy was good, so we thought the pullback was overdone. So we added to our holding in Flexi with that very significant pullback that you touched on.
So obviously you're not worried that there is some insecurity because we don't know who the next CEO is going to be. I know, but it's... Yeah,
sure, but
I'm just trying to find a reason why the market...
we think it's a good business. Yes. And you know, CEOs come and CEOs go, particularly in Australia where you know you have a relatively short life cycle, particularly if you're not producing the numbers. Yeah. And we've seen that in the most recent sort of, I call it the corporate confession season.
Yes.
And you know, we've seen 4 or 5 CEOs take a bullet because they've confessed to not meeting expectations. In this case, it was a view from the board that the market didn't think this guy was charismatic enough, which is, to me, is a bit of a duncy type attitude.
Yeah, well, the tide might be turning for the resource sector, but there's still so much risk still coming in that sector that, I mean, that you run too many failures in your portfolio. Is that sort of your view as well? Are you shying away from resources stocks, or are you thinking...
Well, we own stocks where the earnings are highly predictable.
Okay.
They're going up.
So that's your answer.
They're high quality attributes. There's recurring income stream. There's cash flow.
Yes.
So we shy away from virtually every resource company in the world.
Yeah, exactly. And
fairly flat.
Yeah, I think if you're going to chase commodities, Rudy, I'd go for soft commodities.
You go for the soft ones, yeah?
Yeah, I think cattle, wheat, etc., are looking pretty good, but a lot of the hard commodities, to me, they're in a solid downtrend.
Yeah. See, with the softs, my problem is that their cycles are often very short.
And they're very hard to play.
Yes. Yes, in Australia, because you have small caps.
Yeah.
I mean, yes, exactly. And then before you know it, you try to jump on the bandwagon, then the cycle's already turning. They're sometimes very, very short, unless you go for maybe for dairy. We have a caller. Brian, are you there?
Hello.
Hi, Brian.
Hi.
We want an interesting question.
Well, I hope this is. My question is partly Telstra.
Partly.
And partly the broker recommendations or analyst recommendations. For more than 12 months now, one of the major broker houses has had a $4 something recommendation on Telstra.
UBS.
You said that, I didn't. And I'm curious at such a discrepancy in some of these calls. I mean, it's common to have some of the major stocks with somebody saying hold, somebody saying buy, somebody saying sell. I mean, at least somebody's clueless in the whole thing, aren't they?
No, well, I'll answer that question once we have a little bit later in the program. I think that's the appropriate one to answer. I think it's me here, but we can answer Telstra. And I am sort of thinking that Montgomery might think that Telstra is too expensive, but you still like it in some ways.
Yeah, Brian, we would say Telstra is too expensive, and one of the reasons is that if you look at Telstra over the last, say, dozen years, it earns no more than it did 12 years ago. So that's hardly a stock that promotes excitement. Secondly, you've got to ask yourself, are its earnings going to grow tremendously over the next 3 to 5 years? Question mark. Not obvious to us. Its dividends 10 years ago were 28 cents a share. Its dividends today, 31 cents a share. Hardly exciting. So I treat Telstra as a little bit of a bond, and one of the reasons it's done so tremendously well over the last 3 years, Brian, is because interest rates have come down from 6 or 7% to record lows at 2%. Now, if interest rates ever normalise, all those stocks that are bought who are bond-like or yield-like will then sell off because they don't have strong earnings growth. I would much prefer recommending to you, Brian, companies with really, really solid earnings growth, and then the dividends will grow in time. Yeah. So as a simple example, M2 Telecommunications, 10 years ago is 25 cents, today is $11.
Yes.
10 years ago paid a 1 1/4 cent dividend, today pays a 30-cent dividend. So, you know, this is growth, right?
Yes.
So I think it's much better for people like Brian to find things that are solidly growing over the medium to long term rather than just going sideways. Yeah. If you want something to go sideways, go buy a government bond.
You know, is this something you follow?
Not really, but I have a very simple view about it, listed investment companies, and that is that when they sell at a very good discount to their net asset valuation, they're worthwhile buying, and when they sell at a very good premium to they're worthwhile selling. And I think that applies to REITs as well. So it's precisely the same comment. Look at the net asset valuation and look to buy at a very good discount and look to sell at a very good premium. Yeah. You know, it's like if this thing's worth $1, I don't understand why you wouldn't buy it at 80 cents and sell it at $1.20. Yes. You know, pretty simple. Yes. I think you've got to be very careful with roll-up business models. And what G8 said at one stage is we'll never pay more than X times multiple. And then I know that they took out a fairly significant competitor at X times multiple plus about 50%. Yeah. So they broke the golden rule, but they wanted to take out a competitor. Their indebtedness, I think, is now about 40% of equity. I think their return on incremental equity is not growing, so that's always a bit of a question mark for us. And I think, you know, I think with some of these things you just got to be a little bit wary. And we did like it at one stage, but then we sort of got very, very deep into the accounts. Yeah. And just felt that discretion's a better part of valour, and so we left it, I think, about maybe about 15 months ago we left it, and fortunately, probably sheer luck to be honest with you, the timing was good. Yeah. But with those things, I just think it's better to be on the side of caution. They do look cheap for a reason. Yes. Now, just in terms of roll-ups, we've seen more or less Slater and Gordon very recently. We've seen IOOF very recently, and what happens is when you're making a lot of acquisitions, You know, management have really got to keep their eye on the ball, and the culture and the numbers. And if anything goes wrong, it can really come and hit you in the face. And I think in those latter two examples, that's what's occurred in recent
Spreadsheet errors.
In recent days. But now G8 certainly isn't guilty of that. But I'm just saying, as you roll up, you just got to be very, very careful.
Yes. Do you like Ansell?
Look, I don't think it's the highest quality business on the Australian market, but I don't think it's a bad business either. I think its return on equity is slowly grinding up, but as you quite rightly say, things like exchange rates, rubber prices, etc., you know, they can push the earnings around quite a lot, and obviously
quite quickly too,
and very quickly. And obviously, management have no control over those significant aspects of the business. So, I think it's one that's that, you know, I think it's interesting, and I think in the sort of lower $20 area, I think it's definitely worth a look at. But I think it's probably higher quality businesses out there.
Yeah. I mean, anyway, David, I'm assuming that you're not really into predicting where the index goes.
That's correct.
But maybe, what would be your preferred sectors for the year?
Well, let's just go back to Anthony's question. You know, he was basically poo-pooing the Australian market.
Yes.
You've got to remember that financials account for 45% of the index. Materials account for about 15% of the index. So get those two sectors right. That's 60% of your market. You've got it or you haven't. Now, I'd suggest to Anthony that he gives us a call and invests in our Montgomery Global Fund. That's the starting point, because it seems to me that Australia is a relatively thin market, and the corporate confession season has definitely seen 2 downgrades for every 1 upgrade. So it is not easy out there in corporate world. And Gary's right, it's these record low interest rates are supporting the markets. But any stock that it's worth its weight, he's really struggling to sort of see really solid earnings growth. That said, yeah, could the market get to 6,000? Yes. What does everyone say? Look, over 100 years, markets go up at about 10% a year, right? Yes. You know, no big deal.
It's 10% from here.
And arithmetically, 1 year in 4 are negative, right? No one knows which year is going to be the 1 year in 4 that's negative, but everyone just says, yeah, another 10% next year, because that's the 100-year average, yes. Right? So there's no great...
He's giving away the secrets!
Yeah, so there's no great science in any of this, but I think what you've got to do is you've got to look at the major stocks that really make up the benchmark, and really, as I say, it's 2 sectors. It's financials and it's materials.
Yes. But ETFs, in short, before I pass you on to someone who can give you much more detail about it, are essentially an easier way to play themes or financial assets outside of fund managers or individual stocks. And are they good? There's a lot of criticism. And for example, I discovered recently that the share price of one of the mining service providers in Australia had a bump of 60% without anything being announced, and it turned out that one of the ETFs was buying it. That's what happens in the share market. ETFs, do you personally like them, David? Do you use them?
Don't use them. I think they're suitable for someone who just wants to buy the market or a sector at a very, very low cost. But I think that if you're a value investor, like Montgomery is, what you're trying to do is outperform the market. Yeah. And we've been successful at doing that. But
well, that's because you're successful as a stock picker. But yeah. I can, if I play devil's advocate, I can pop, for instance, I can see the value of, let's say, I want to buy gold stocks. And I don't know which particular one, because I might risk that I just buy the one that doesn't go up at the right time. The ETF probably just takes away that risk.
As I say, if you just want to buy a sector in a very, very low cost way of doing it, in a very passive way of doing it, yeah. You know, it is quite suitable.
We're approaching the end. Do we have famous last words? 5 seconds you have. A stock, a sector you like?
Famous last words, I think...
only 3 seconds.
Oh, I like Aussie equities.
Aussie equities in general? Yep. David, famous last words?
I think Australians need to get a bit more money offshore, and the Montgomery Global Fund would be a good way to do it, Rudy.
Okay, I think you should pay for advertising. Yeah, anyway, this was us sharing our insights. We're not advisors, definitely not for you, because we don't know who you are. And I obviously thank David and thank